hearing has been scheduled on tax day, April 15th, and we're talking about taxes. We have some witnesses here that are experts in the field and have experienced a real-life experience in terms of dealing with our tax code from a small business owner's standpoint. And so we're looking forward to that testimony. There are vexing challenges facing us with our tax code, burdensome on business, individuals, and others, complex beyond our ability to fully understand it. The small business owners that I have met throughout Indiana have been patient, persistent, and overcomers. Despite the obstacles that small businesses face, they're responsible for 2/3 of the net new private sector jobs created in the United States. So it's important that we listen to you, understand the challenges that you have. Our role as legislators should be to ensure that the tax code is no longer a major obstacle to growth and jobs for these businesses. Against the headwinds of the slowest recovery since 1960, small business owners have to deal with a tax system that is hopelessly complex, full of provisions that expire every 1 or 2 years, riddled with special exemptions, deductions, and preferences, and filled with new penalties. The Small Business Administration lists tax paperwork as the most costly paperwork burden the federal government imposes on small businesses, adding up to about $1,500 per employee. It's not surprising that 9 out of 10 small business owners have to turn to an outside paid professional to figure out their taxes, as I have to do, even though I took 3 tax courses in law school. I can't begin to plow my way through the complexity of our tax code. Today we will hear from witnesses who can discuss how tax policy is affecting the broad landscape of small businesses. We will also hear 2 stories of real businesses that will bring home how taxes affect companies on the ground. Tax day is a perfect time to commit to not let another April 15th pass before we finally tackle comprehensive pro-growth tax reform. And while it is urgent and essential to lower our corporate rate tax, which is the highest in the developed world, we must not forget the millions of small businesses that pay taxes at the individual level and have just experienced rate increases. I look forward to hearing from our witnesses about how we can tear down barriers to growth in our broken tax code. I now want to recognize Ranking Member Maloney for her opening statement.
I want to thank very much Chairman Coates and all of our witnesses for being here today. There is a broad agreement that small businesses are the backbone of our economy, the anchors of our communities, and that they have played an important role in our current recovery. When President Obama took office over from former President Bush, the economy was in a free fall, and small businesses were bearing the brunt of the pain. Over the fourth quarter of 2008 and the first quarter of 2009, small businesses shed more than 3 million jobs. President Obama and Democrats in Congress, along with the Federal Reserve, took bold actions to turn things around in the darkest days of the Great Recession. These actions included a number of efforts designed specifically to support small businesses. For example, the Recovery Act cut taxes for small businesses, allowing them to immediately deduct up to $250,000 of investment, carry back losses for 5 years, and exclude from taxation 75% of all capital gains from small business investment. Several small businesses in my district told me that this initiative alone helped them save their business. Today, small businesses are leading the economic recovery. Small businesses have added more than 6 million jobs over 17 straight quarters of small business job growth, which we can see in this chart number 1, where we have been growing up with a solid blue rise of adding jobs for small businesses. We have come a long ways in the past 6 years. The share of small businesses planning to add jobs is back near the pre-recession average, as we can see here in this chart too. While this reflects major progress, I believe that we need to do much more to support small business growth. The administration's tax reform plan, for example, would simplify and cut taxes for America's small businesses. President Obama's revenue proposal includes expanding and permanently extending increased Section 179 expensing for small businesses. The proposal would also increase the number of small businesses that take advantage of simpler cash accounting rules. The administration's approach provides tax cuts for small businesses in a fiscally responsible way and in the context of broader business tax reform. By contrast, the Republicans in the House have passed bills without offsets, which would blow holes in the budget. Some of my Republican colleagues would have us believe that small businesses are up in arms about President Obama's proposals. But this chart, based on a survey and data provided by the NFIB, a very respected organization, one of our witnesses today, and is here from the NFIB, shows that the share of small businesses listing taxes as their top concern is no greater today than it was when former President Ronald Reagan left office, as we see in chart number 3. One of our principal goals today should be to decide what a small business is for tax purposes. While most of the 95% of businesses that are organized as pass-throughs are small, many are extremely large. Numerous large law firms, accounting firms, hedge funds, and other businesses are pass-throughs. The tax code treats these large businesses the same as mom-and-pop stores down the street. And one of my questions will be today, should we treat them the same? When designing tax policy, fairness should be a principal concern. Some large multinationals pay less than small businesses, and some extremely large companies don't pay any federal taxes at all. In other words, the corner store likely pays more in federal income taxes than some of our country's largest corporations. Those who are critical of our tax system should save some of their outrage at this. Before taking on tax reform, Republicans have proposed repealing the estate tax, and they plan to vote on it in the House later on today or possibly tomorrow. Let's be clear, repealing the estate tax would be a major windfall for some of our most privileged and wealthiest citizens. With the current exemption amounts of over $5 million per person, that means a couple could deduct $10 million per couple. The estate tax affects only 2 out of 1,000 estates. In other words, 99.8% of Americans do not pay any estate tax at all, as we see in Chart 4. Republicans say they are motivated by a desire to protect small businesses, but that's something of a Trojan horse, I believe. Only about 20 small businesses and small farm estates owed any estate tax in 2013, according to the Tax Policy Center. Only 20. Repealing the estate tax is also very expensive. The Joint Committee on Taxation found that repealing the estate tax would increase the deficit by $269 billion over 10 years. In 1986, it was a massive overhaul and simplification of our tax code. The minute the ink was dry, work began to undo it. And trust me, it wasn't small businesses that were at that tax table. We must make sure that any tax reform benefits the small firms, not just the big multinationals gaming the system to further limit their tax obligation. Tax reform is hard. That's why there hasn't been a major rewrite of the code in about 30 years. For it to work, it must be comprehensive and it must be bipartisan. I've always said the best legislation is always bipartisan. And I look forward to hearing the perspective of our witnesses today on this important subject. Small businesses create massive amounts of jobs in our great country. Thank you for coming here today. Thank you for appearing before our subcommittee.
Well, thank you, Ranking Member Maloney, and I will now introduce our witnesses. I think we could put on a pretty good show here if I turn it right over to my colleague, Congressman Brady, and to talk about estate taxes, which the House will be voting on, I think, at 4 o'clock or so. So we're going to try to move through this fairly quickly so our House members in particular have an opportunity to speak and ask questions. But we have, with the joint chambers and two parties, we have somewhat of a Byzantine balancing act here in terms of making sure that everybody gets an opportunity in a fair way. Let me quickly introduce our witnesses. Brian Reardon is president of the S Corporation Association and a principal at Venn Strategies. From 2003 to 2005, Mr. Reardon was special assistant to the president for economic policy, working within the President's National Economic Council. He has also worked on Capitol Hill and for the National Federation of Independent Business. Jody Fledderman is the president and CEO of Batesville Tool & Die in Batesville, Indiana, a company that supplies precision metal stamping components for the automotive and appliance industries, among others. He's also past chairman of the Precision Metal Forming Association and serves on the boards of New Horizons Rehabilitation, the Indiana Manufacturers Association, and the State of Indiana Chamber of Commerce. Holly Wade, Ms. Holly Wade is the Director of Research and Policy Analysis for the National Federation of Independent Businesses. In addition to providing analysis to small businesses on public policy, she helps produce NFIB's monthly Small Business Economic Trends Survey. She also serves on the Department of Commerce Industry Trade Advisory Committee on Small and Minority Business. Martin Sullivan, Dr. Martin Sullivan is Chief Economist for Tax Analysis, writing frequently in tax publications. Previously, he taught economics at Rutgers University and served as a staff economist at the U.S. Department of Treasury and later at the Joint Committee on Taxation. He graduated from Harvard and has a PhD from Northwestern University. And finally, our witness from Minnesota, who I'm going to let Congressman Paulson introduce. Senator Klobuchar sent her regrets. She'll be arriving, but late. So, Congressman Paulson, I'd love to have you introduce our witness from Minnesota.
Well, thank you, Mr. Chairman, and it's my pleasure to welcome Mr. Thomas Hoghaug. He is has a long and accomplished career in the medical device industry. In particular, he's currently CEO of both Signus Medical as well as Lockdown Surgical in Chanhassen, Minnesota, which is my hometown. I'd like to thank Mr. Hoghaug for his participation in today's hearing and his willingness to discuss some of the challenges, the very real challenges that the medical device industry tax is presenting to his companies and so many others like them in Minnesota and around the country. And I do expect, Mr. Chairman, that his testimony will prove very valuable to members of the committee as we seek ways to ease the tax burden faced by America's small businesses today.
Thank you, Congressman. We will go in order that I just read, starting with you, Mr. Reardon, and then followed by Mr. Fledderman and Holly Wade, Mr. Hoghaug, and then Dr. Sullivan.
Chairman Coates, Vice Chairman Mr. Brady, and Ranking Member Maloney. I appreciate the opportunity to testify before the committee today. The S Corp Association and its allies have been active on business tax reform efforts for about 5 years now. And in that time, we've developed a number of themes that I'd like to emphasize today. It's explained more fully in my written testimony. First, if you were starting from scratch, if Congress were starting from scratch, it would use the S Corp as the model for taxing business income. The basic principles are that income is taxed once and only once. It's taxed when the income is earned, and regardless of whether the income is distributed to the shareholders, and it's taxed at progressive rates. High-income shareholders pay high rates, low-income shareholders pay lower rates. That's the correct way to tax business income. Second, S Corps are doing exactly what Congress intended them to do when they were created 50 years ago. The S Corp was created to incent private and family-owned businesses, and it's worked. Today, there are 4.6 million S Corps, and they're in every community and in every industry. And Congress has acted over the last 50 years on numerous occasions to improve the rules and to enhance the ability of families and entrepreneurs to use the S Corp model to structure their businesses. Third, you hear lots of talk about the erosion of the corporate tax base. What you don't hear is that the business tax base, that is, pass-through businesses plus C corporations, has actually grown over the last 30 years since the 1986 Tax Reform Act. Prior to 1986, the business tax base was about 9%, almost wholly made up of C corporations, 9% of GDP. Today, it's 11% of GDP, 6% pass-through, 5% C corp. So it's grown, and it's grown wholly because of the growth and progress of the pass-through community. Fourth, pass-through businesses employ most of the private sector workers out there. Every day, 55% of private sector workers get up and they go to work at a pass-through business. So in some states, nearly 7 out of 10 workers work at pass-through businesses. Fifth, Pass-through businesses pay taxes, and they pay lots of them. There's this theme out there that if you're not paying the corporate tax, you're not paying taxes at a reasonable rate. That's been something that we've been concerned about for a long time. Back in 2013, we asked an econometric firm to study how much do businesses pay, what's their effective rate by business structure. I think it's the only time anybody's ever done that study. What we found was that S-corps have the highest effective tax rate, about 32%. Big S-corps, the large ones that people want to pay taxes like C-corps, they pay an effective rate of 35%. So they're paying lots of taxes right as they are right now as S-corps. If you look on this thing, you can see the C-corp number is 27%. An important point is that of that 27%, dividends makes up 2 percentage points. So there is a second layer of tax on C-corps. Here, dividends are represented, capital gains are not. So you'd have to add that in, and we weren't able to calculate the capital gains thing. But the bottom line is that pass-through businesses pay tax when it's owed, and they're paying a lot of tax. Sixth, the tax rates on pass-through businesses, they just went up, and they went up a lot. As a result of the fiscal cliff and the Affordable Care Act taxes, the top rates on pass-through businesses increased from a marginal rate of 35% to almost 44%. You can see the components up here. The main rate went up to 39.6. There's the new Affordable Care Act tax of 3.8%, and then the reinstatement of the P's limitation on itemized deduction adds about 1.2%. When you combine that with state and local taxes, some pass-through businesses are paying more than 50% marginal rates on their income. I mentioned all these points to set the table to talk about tax reform. Back in 2011, the Treasury Department floated a proposal to broaden the tax base by eliminating business deductions and credits and to use the revenue to lower the corporate rate. The challenge for S-corps and other pass-throughs of this plan is obvious. They use the same deductions and credits, but they pay individual rates, not corporate rates. What might this look like? I think we have a new slide here. Yeah, here it is. So here's two similar companies. They both 20 million in revenues. They both use the same deductions and credits. You can see right now the S-corp or the pass-through is paying a higher top rate than the C corporation. Now, if you try to do a tax reform, and I'm not advocating this, but if you go to the next slide, and you eliminated those credits and deductions, you can see that under the administration's plan, the C corp will get a 25% rate. The S corp is still paying 44.6. That's simply unsustainable. So pass-through businesses, we oppose corporate-only tax reform. What do we support? Since 2011, we've advocated the following three principles for tax reform. One, it should be comprehensive. Two, it should lower rates for pass-throughs and C corporations alike. And three, it should reduce or eliminate the double corporate tax. The double tax on corporations is the reason U.S. businesses are uncompetitive. We're the only one of only a few countries to actually impose a double tax on our corporate businesses. We should simply get rid of it. So what are the takeaways? One, S corporations are the correct way to tax business income. Two, pass-through businesses are a significant part of the economy. Three, the top rates on these employers just went up significantly. And four, tax reform done right should be comprehensive. It should lower rates on pass-throughs and C corps alike, and it should reduce or eliminate the double tax on corporations. I appreciate the opportunity to testify, and I look forward to answering any questions.
Mr. Reardon, thank you very much, and I appreciate you staying close to the 5-minute rule. That helps give us time to have a good interaction with the witnesses. Thank you. Mr. Fledderman, you're on.
Yes, first of all, thank you for the opportunity to testify today before you. My name is Jody Fledderman. I'm the president and CEO of Batesville Tool & Die in Batesville, Indiana. I've been the president of that company since 1989. We provide metal stamping and assemblies mostly for the automotive industry. I'm here to talk to you guys today a little bit about our business and what the taxes do to us. We have 395 employees at this facility, and we would actually hire more if we could find enough qualified workers. I'm not a tax expert, but I'm here to tell my story from a business owner perspective and how these tax laws are affecting us. We have a lot of obstacles that we have to deal with as manufacturers. The single biggest obstacle for us to deal with right now is the uncertainty in our tax code. It's very difficult for us to plan the future when we don't know the rules for today. It feels as if people in Washington are insulated from what's going on in these small businesses, that they don't realize by not doing something can affect us as much as doing something. That's why I believe also we need a comprehensive tax reform. Not just to lower our rates to globally competitive levels, but also to provide stability and predictability for us. Washington should develop tax policy that encourages investment and manufacturing in America, not penalize companies and their owners for doing business in the U.S. But we need tax reform for all businesses, not just C corporations. A January 2015 industry survey showed 61% of metalworking companies are pass-through businesses. Sector-wide, 81% of all manufacturing companies are pass-through and paying much higher taxes, as you saw from the previous slides. This means that C corporation-only reform leaves behind 8 out of every 10 manufacturers, mostly small and medium-sized family-owned businesses. We're one of those millions of manufacturers that corporate-only reform would leave behind. Our company is structured as a S corporation. We're a multi-generational manufacturing business with very strong ties in the community, and we've awarded shares an opportunity for ownership to a lot of our key employees that are key to our success. Because of that, we are now at 72 shareholders, so we're a little unusual for an S corporation. We're not a 1 or 2 owner company. A main reason most family-owned or tightly held manufacturers structure themselves as pass-throughs is to make it easier to transition the business to your family when you retire. Some of our shareholders are high school students. Some of them are retirees in their 80s. There's no way they could cover the tax penalties of a sale or a buyback if we were a C Corp. So this is one of the main reasons that being structured as S Corporation is so important for us. The main drawback to being a pass-through structure is the most obvious. As you saw in the slides before, publicly most people believe the top rate is 39.6. In reality, we're paying in at 43.4% for our federal income taxes when you calculate in the surcharges and some of the other additions. Now, keep in mind, we've got 72 shareholders, and we also have one that is a fully passive income shareholder, which is why we pay the extra 3.8% tax. We have to pay that extra tax for everybody. So we pay it to 43.4% for all of our shareholders, and even if that's not what their tax liability is, and then it's up to them to try to get those refunds on their own. Now, because we're not a 1 or 2 owner company, that money doesn't come back to the company. That ends up with our shareholders if they can claim it or they have tax attorneys that can do that for them. We've looked at several different scenarios. Had our tax rates not increased to 44%, we would have had an additional $500,000 for our manufacturing operations. If Congress were to lower the effective tax rate to even 28%, it would reduce our tax liability by $700,000, obviously more if lowered to 25%. Again, the public perception plays a big role in this. The average person assumes that the owner takes that $700,000 and puts it in their pocket, when obviously they don't. That's reinvested back into business. Profit margins in our industry are usually less than 3%. So all the investment back in the business comes from any profitability that we're able to generate. While tax rates receive the most attention, nothing frustrates us more in manufacturing than the constantly expiring tax credits and deductions. That's really the biggest problem for us. We feel like Congress takes too casual of approach to the tax extenders, knowing that, well, we'll get to them eventually. What Washington doesn't understand, I believe, is that we rely on those provisions to plan our investments and expansion years in advance. Right now, we are mulling the purchase of a $3 million machine that would probably add 15 to 18 jobs to our business, but it will take 16 months to get that machine in service. And we have no idea if we'll be able to use Section 179 or a bonus depreciation to apply to that investment. I'll wrap up here. But what happened to us in 2014, I told the story in Senator Coates' office, and I think it's one of the reasons why I was asked to come here to talk today. We pay the taxes on behalf of our shareholders every quarter. We make quarterly estimate payments. And by the end of the third quarter, we were paying in at our 44% nearly. And so the week before Christmas, we find out what credits will be extended. Well, we find out that the taxes we had paid through the third quarter was already $600,000 more than what our tax was supposed to be. So that's tax that now we've paid into the federal government that we shouldn't have, and that will end up coming back to our shareholders in some form or another. Some of it will, if our shareholders' tax accountants are savvy enough to get it back. But that's $600,000 that we'll never see back in our business as cash flow. So, in summary, my real feeling is that, you know, people are never really going to be happy with the tax code, no matter what it is. They're always going to think it's too much. But the real problem is that we can't plan our future. We're being asked to compete globally and compete with people all around the world. We already have one of the highest tax codes of all the countries in the world, and then not knowing what the rules are makes it almost impossible for us to plan a future. Thank you again for your time.
Ms. Fledderman, thank you very much for your testimony. Ms. Wade.
Good afternoon, Chairman Coates, Ranking Member Maloney, and members of the Joint Economic Committee. Thank you for the opportunity to testify today. I am pleased to be here on behalf of the National Federation of Independent Business as the committee discusses small business tax policy and economic growth in the small business sector. The small business economy is slowly emerging from one of the worst recessions in U.S. history. NFIB's Small Business Economic Trends Survey data shows the dramatic change in consumer spending, employment, employers' confidence, and business investments throughout the recession and subsequent recovery. While some business activities have made significant improvements over the past 4 years, capital expenditures and outlook on business conditions and expansion remain at historically low levels due to economic conditions and the political climate. The threat of higher taxes, whether in the form of income taxes, the healthcare law, the estate tax, Section 179 expensing limits, or others, create enormous uncertainty among small business owners worried about the impact of policy changes on future business costs. The survey also tracks which problems most affect owners in operating their small business. From mid-2008 through mid-2012, poor sales was their #1 problem as consumer spending declined sharply. But now taxes is often the #1 concern for small business owners, a problem that moderates the economic recovery in the small business sector. The NFIB Small Business Problems and Priorities Survey highlights 3 main areas of tax policy that are of great concern to small business owners. With the cost of health insurance leading as the most severe problem for small business owners, 5 of the top 10 problems are all tax-related. These tax problems fall into 3 categories: cost, complexity, and frequent changes. The cost of tax obligations is threefold: the amount paid to federal, state, and local tax agencies, the cost of hiring a CPA or tax advisor to navigate complex tax codes, and the owner's time in providing the required paperwork and/or filing themselves. 88% of small employers use a tax preparer, and most use one to either ensure compliance or because the requirements are too complex. Tax-related regulations cause the greatest difficulties for 40% of small employers, more than environmental, health and safety, or employee-related regulations. And compliance costs are especially problematic as they are 76% higher for small businesses than for their larger counterparts, costing them $18 to $19 billion a year, or about $74 per hour. Tax-related costs compete with the owner's ability to use limited profits for primary business activities. Profits are the main funding mechanism for owners purchasing new equipment, expanding facilities, hiring, and stocking inventory. Tax-related cost pressures are especially problematic for newer firms that almost solely rely on profits for operation and expansion costs, as they are generally not able to access traditional lending sources. But regardless of the firm's age, the tax burdens take a heavy toll on owners' ability to operate their business. One example that encapsulates all 3 categories of tax-related problems for small business owners is the Affordable Care Act. The employer mandate, small business tax credit, and the termination of employer reimbursement plans are just a few of the many tax-related costs and complications small business owners face in complying with the new law. The ACA, though, is just one example of how excessive tax burdens affect small business owners. And the federal tax code is only one layer of tax obligations owners face in operating their business. They must also comply with state and local taxes, adding to the overall compliance burden. Unfortunately, only the owner experiences the cumulative effect of all the required taxes and regulations placed on their business. Federal, state, and local lawmakers and government agencies only see them in isolation, giving a false perception of their true impact. In conclusion, small business owners continue to be excessively burdened by direct, indirect, complicated, and ever-changing taxes related to operating their business. Alleviating the excessive tax burden on small business is an essential component to creating a strong, healthy environment for owners to operate and grow their business. I appreciate the opportunity to present NFIB's views and data on the effects of tax policy on small business, and I look forward to answering any questions you may have.
Thank you. Thank you very much. Mr. Hogg, thank you.
Chairman Coates, Vice Chairman Brady, Ranking Member Maloney, Representative Paulson, I thank you for the opportunity to testify. My name is Thomas Hoghaug. I currently hold the position of CEO for Signus Medical LLC and Lockdown Surgical, Inc. It is an honor for me to be able to address this committee today and personally shed some light on the extremely negative impact the medical device tax has had on both of my companies and on similar small medical device firms. The issues and examples I will share are personal examples that are in no way unique to Signus Medical and Lockdown Surgical. They are common experiences shared by a multitude of device firms and have been conveyed and confirmed to me during meetings, committees, and gatherings of medical device executives. Small device firms are primarily responsible for the majority of innovation and development of better and more cost-effective treatment modalities for patients in the United States. I've worked in the orthopedic medical device arena for over 27 years, including as a founder of over 10 companies. Signus Medical is a master importer, developer, and distributor of spinal implants, while Lockdown Surgical is an extremity company focused on joint ligament repair. Both teams are focused on improving the quality of life and reducing human suffering. Lockdown Surgical was founded in February of 2012 with a single FDA-cleared product for shoulder repair. It has been operating at an annual financial loss and expects to reach break-even finally and begin to turn a small, modest profit in the fourth quarter of this year. It would have been sooner if there was not for the medical device tax. With the introduction and the implementation of the Affordable Care Act's medical device tax, companies have experienced a multitude of unforeseen and crippling consequences of the tax, including layoffs, non-replacement of lost employees, disrupted or negative cash flow, curtailing or elimination of R&D projects, reduced inventory expansion, and effective tax rates which can exceed 100% of profits. Money that was once used to grow and reinvest in the expansion of the companies is now sent to the IRS every 2 weeks. Another perhaps unforeseen but very significant impact of the medical device tax is disruption of both of my companies' cash flow. As mentioned earlier, payments are made within 2 weeks of posting sales, but collections are running upwards of 70 days. These payments strip both firms of ready cash, which was previously used for day-to-day operations, payroll, payments to vendors. Since 2012, our monthly cash flow has been negative due to the device tax. As of last year, I shelved 2 major R&D projects because of the device tax. Instead of investing in innovation, we are looking at how we will simply manage through the cost of introducing several new products in 2015, which would, under pre-tax condition and expectations, return Signus Medical to nominal profitability and expand Lockdown Surgical products into other areas of the body where there is a very real and significant patient need. Most difficult for me, I had to personally lay off a number of team members specifically to pay this medical device tax. I'm very proud to be actively involved in the medical device arena. It has historically been a shining star in the U.S. economy and has supported some of the highest paying jobs when compared to all other business sectors and average wages. The advancements in treatment and improved patient outcomes is commonly a direct result of smaller and more nimble device companies such as Signus Medical and Lockdown Surgical, who reinvest profits and resources into the development of new and more cost-effective surgical and non-surgical solutions. Simply put, the device tax is destroying our ability to deliver on the promise of improved patient care. This is something I will not compromise on. With the inclusion of the medical device tax in the 2014 operational budgets, both Signus Medical and Lockdown Surgical posted effective tax rates in excess of 110%. This is not sustainable for any business, large or small. I fear once again I will be facing employee downsizing and further elimination of development projects, and thus new clinical therapies to patients in the United States in order just to remain in business to pay the device tax. Money required for reinvesting in expanded infrastructure, including employees, new inventory, and promising R&D projects is no longer available. Again, these problems are not unique to my 2 companies and are clearly felt across the entire medical device industry. I do believe, however, that smaller and startup companies are more severely impacted by the device tax given their inherent size and inability to spread or defer the cost of over non-device products being sold by larger and more vertically integrated companies. In conclusion, I would like to thank the committee members for this opportunity to testify. I sincerely hope that the information and personal experiences I have shared help to enlighten you as to the true negative impact the medical device tax has had on the medical device industry as a whole and smaller and startup companies in general. Growth and innovation and new job creation come from small medical device firms. The medical device tax threatens to kill off or at very least curtail this segment of our industry. Thank you.
Mr. Hoghaug, thank you very much for your testimony. And now Dr. Sullivan.
Chairman Coates, Vice Chairman Brady, Ranking Member Maloney, members of the committee, thank you for this opportunity to testify. Two recent developments have heightened interest in tax relief for small business. First, in 2012, Congress allowed the top individual rate to rise from 35 to 39.6%. Second, there is concern that Congress will pursue corporate-only tax reform that would cut the corporate rate and, to pay for that lower rate cut, reduce tax deductions and credits for all businesses. This would hurt small business that would lose tax breaks but get no relief from the rate cut. In my remarks today, I'll briefly comment on 5 options for small business tax relief. Option 1, Congress could reduce the top individual rate to 35% or lower. We should always strive to keep tax rates as low as possible, but the case for lowering the top tax rate should not pivot on the effect that it would have on small business, but on larger issues such as the need for deficit reduction, the effect of rate cuts on tax fairness, and the effect of a rate cut on the overall economy. The figure on the screen shows a box. The box represents all the income affected by a change in the top individual rate. Only 30% of pass-through income is in this box. Only 21% of it is related to pass-through employers, and only 8% is related to small business employers. The bottom line, most of the benefit of cutting the top rate would not go to small business. Option number 2, Congress could cut the top individual rate, but limit that rate cut only to pass-through businesses. And several states have adopted this approach. Most notably, in 2013, Kansas completely exempted all pass-through income. One problem with this approach is that it opens the door to aggressive tax avoidance. Secondly, much of the benefit would not go to small business, but go to large businesses, some of them very large. Here are the facts. In 2011, there were 15,000 S corporations with more than $50 million in sales. They accounted for 27% of all S corporation profits. And there were 22,000 partnerships with more than $100 million in assets. They accounted for 64% of partnership profits. Clearly, we should not equate pass-through business with small business. Option 3, Congress could limit any rate cuts for pass-through business to certain industries. Dave Camp's tax reform provided a 25% rate for manufacturing and construction pass-through business. This target approach is a lot less expensive, only about a quarter of the cost of an across-the-board pass-through tax relief like they had in Kansas. But why should we favor some industries over others? And why, if we want to create jobs, should we exclude labor-intensive service and retail businesses? Another problem is the complexity. It's hard to figure out exactly which business lines qualify for these benefits, as demonstrated by our current difficulties with the Section 199 deduction for domestic manufacturing. Option number 4, instead of providing back-end tax relief for small business income, Congress could provide front-end relief for business costs, such as capital spending, wages, and research. This approach has several advantages. First, it's far easier to measure qualified costs than it is to isolate income that are qualified for these benefits. Second, there's far less opportunity for tax planning. And third, this approach can target activities that promote economic growth. So, for example, if Congress wants to create jobs, it can do this more effectively with a wage credit than with a rate cut of equal revenue cost. Deducting the full cost of capital equipment when purchased is called expensing. As tax breaks go, expensing for small business is one of the most meritorious. It's an incentive for capital spending, it's better than a rate cut, it increases cash flow, and it simplifies record keeping. Besides a wage credit or expensing, Congress could make the research credit more attractive to small business by making it refundable, as several states have done. And option number 5, which is simplification. Of course, everybody wants simpler taxes, but simplification is especially important to small business. Compliance costs per employee are much higher for small firms than for large firms. It's the economic equivalent of a tax surcharge just for being small. One particularly promising approach for small business tax simplification would be expansion of the cash method of accounting. So, in conclusion, to help small business, we should avoid rate cuts that are poorly targeted, complex, and spur costly and unproductive tax planning. Instead, we should provide tax relief tied directly to investment and employment. And most of all, we should simplify. Simplification is a surefire way to reduce costs for business, to promote growth with minimal impact on the deficit. Thank you.
I want to thank our witnesses for their testimony and look forward now to the interaction between the members. I want to turn this over now. I'm going to defer my time. My House colleagues, I know, have an important vote on taxes, interestingly enough, coming up at 4 o'clock, and see if we can get as many of them some time here as we can. I do want to turn to our ranking member, Ms. Maloney, and then we'll hear from Mr. Brady.
I want to thank you all for your testimony, and thank you, for being sensitive to our time. One of the biggest challenges in crafting tax policy for small businesses is deciding what counts as a small business. Many Americans, when they think of a small business, think of the corner grocery store. But clearly, small business is much more than that. And there are dozens of possible definitions based on revenues, number of employees, average revenue per employee, industry classifications, or other characteristics. And defining what a small business is critical to the success of our hearing today. And I'd like to ask Ms. Wade from the NFIB, can you tell me in 2 or 3 sentences for the purpose of tax policy, what is a small business? How would you define it?
For NFIB members, most of our members are under 40 employees. However, they span all industries and all size groups. So for tax policy, the policy that would benefit most of them would be lower rates and simplification and reducing the changes in the tax code. There isn't a strict definition because there are many firms that are labor-intensive versus capital-intensive. So it's a broad spectrum that we represent.
Okay, is a global law firm with dozens of offices around the world a small business? Ms. Wade?
It depends. It depends what the composition of the firm is. We have many, we have manufacturers who export. We have members who span every industry. So tax policy that can cover most of them would be our choice for pro-growth, supporting most small businesses.
Is a hedge fund with billions in assets a small business, Dr. Sullivan, would you say?
I think it's just common sense that that's not a small business.
What about a global law firm?
Well, as we know, they can have thousands and thousands of partners. They are considered a pass-through business. They're taxed as a partnership, but they're certainly not a small firm.
Okay, Mr. Fledderman, you run a successful tool and die company, and you have I would say, a personal stake in this issue. Do you think, for example, that a global law firm or a hedge fund should be classified as a small business?
Oh, I don't really know if it should be classified as a small business, but
For the purposes of tax code.
No, I don't. I think that, what I think manufacturers and people that make things, obviously I'm more on that side since that's what we do, but that's what really generates the jobs in this country. We all know that, and I believe that that's what we should be concentrating on.
Well, Dr. Sullivan, could you please tell me very briefly what is a pass-through? What exactly is it? And is a pass-through the same thing as a small business?
A pass-through business is one of 3 classifications under the tax code, either a sole proprietorship, a partnership, or an S corporations. They're called pass-throughs because, as all these folks here know, the income is not taxed at the entity level, it's taxed on the individual level. However, it is not the same thing as a small business. Most small businesses are pass-throughs, but not all pass-throughs are small businesses. There are many very large pass-through businesses.
Will these large entities with hundreds of millions and even billions in revenue be treated the same and face the same tax structure as the local laundromat and the neighborhood deli? Dr. Sullivan.
Well, it depends on how, I think the example I like to use is a real live one in Kansas, where where the Governor Brownback put in legislation to exempt all pass-through business from all income tax in Kansas. It was discussed as a small business tax relief, which it was, but it also provided tax relief for the largest businesses in the state.
And are there steps that we could take to better differentiate in the tax code between traditional small business employers and huge companies organized as pass-throughs? And what steps would you recommend, Dr. Sullivan, since you have written and studied this?
Well, I think ultimately we're talking about job creation, so I would suggest targeting the tax benefits to those businesses that have lots of employees rather than just lots of assets.
Thank you. My time has expired.
Thank you, Congressman Brady.
Thank you, Chairman, for calling this important meeting. I do have a statement I'd like to submit for the record. And,
we will accept that. So.
and the gist of the statement is to lay out the economic benefits of repealing the estate tax and the harm it does to our economy and family-owned farms and businesses, especially growing group of women and minority-owned businesses, building wealth for the first time in America. We think that's a good thing. And it also lays out the need for tax reform and the fact that a recent poll, 80% of Americans believe Congress ought to act now to fix this broken tax code, and lays out sort of the principles for it. Quick question for you, Mrs. Wade, and then a tax question for the others. On the estate tax, we are told that, that this is just tax cuts for the wealthy, that your members are the Paris Hiltons of the world, the robber barons of the Teddy Roosevelt day, that this doesn't benefit average Americans. But my understanding from NFIB and other groups is that this death tax is the #1 reason family-owned farms and businesses aren't passed down to the next generation, that it is hurtful to the economy, that it harms jobs, it is the wrong tax, the wrong time, hurts the wrong people. And studies show that repealing the estate tax would actually create more revenue for the federal government than keeping it in place. And part of the damage is that the businesses use so much time, devote so much time in money to planning to survive the death tax rather than investing in their companies. So for your members, small businesses, would repealing the death tax help them spend more money and time on growing their business and jobs and less time on just doing the tax planning that they have to do today?
Certainly. We've produced a number of studies looking into succession planning for small business owners and small employers, and how they're trying to work through the estate planning phase of our members. So about 30% are looking to pass their business on to family members. And while the state tax, affects a number of them, more of them are spending resources in trying to plan for this. It's the uncertainty of where their business is headed in the future. It's the uncertainty of what thresholds the state tax will be in the future. So in our latest survey, tax survey, 34% in the last 5 years of small business owners have used capital to, or have paid for trying to plan for an estate tax. So 35%, probably many or fewer will pay the estate tax, but it's a misallocation of resources.
No, that's a good point. The claim is just very small pay for. You're saying 1 out of 3 of your members have to plan to devote resources to it. That's the impact. For the others, there's often in tax reform a trade-off between lowering rates and reducing depreciation or increasing depreciation. So my view is that corporates are extremely important. So is cost recovery, the ability to invest, recover those investments, reinvest it back into that as a big driver of Main Street jobs. So I wanted to ask the other witnesses today, any advice to us as we look at this issue? Is capital cost recovery equally important to rates when it comes to business growth? Mr. Reardon?
Oh, I think it's incredibly important. You know, I know there are a couple plans out there, including one put forward by Senator Lee, to allow full expensing and effectively shift the taxation of business income from an income-based to a consumption-based approach, which I think most economists agree is the correct way to go. It also has the benefit of being incredibly simple. I mean, you go out, you buy a piece of equipment, you write it off. You don't have to keep track of depreciation schedules. You don't have recapture. You don't have all that stuff. So it benefits on both sides. It reduces the cost of capital, and it increases simplicity.
Thank you, Mr. Reardon. Mr. Fledderman?
Oh, yeah, I agree 100%. It would be very beneficial. But again, I'll stress that it's really important for two things. Number one, that we know what the rules will be, and that if this is some type of expensing, it's made permanent. So many of the piece of equipment that we have take months to put into service, and when we're informed the third week of December what's going to be allowable, we've got a week left to purchase something over Christmas. That doesn't really work that way.
Sense at all. No, thanks for that point, Mr. Howell. Then Dr. Sullivan.
No, I would agree that estate planning is something that I used to actually consider and look at for succession to my children and all. Right now, given the medical device tax, its negative impact on this, I'm just worried about being in business in a few years.
Having an estate.
So, you know, right now that planning has been set aside in lieu of planning on the day-to-day business.
Thanks. Dr. Sullivan, briefly, I'm out of time.
Sure. Capital expensing and bonus depreciation are very important and effective incentives for capital investment, especially for small business, because it gives them the additional benefit of cash flow. The problem is it's such a good incentive that it might be better than a rate cut. And so when you're looking at trade-offs, when you have a limited budget, it makes it very difficult to talk about lowering the rate and doing capital recovery at the same time.
Thank you, sir. Thank you again, Chairman.
Senator Klobuchar.
Did you want to let some House members go first? I understand they have a vote. I can wait 20 minutes or so.
They do have
Yeah.
some concerns. I've just been told it's been pushed back a little bit, but I
Well, they can-
don't. But if you're willing to defer,
Yeah,
I
they could go
deferred
while I
also.
just have to
So,
leave in like 20 minutes. I'm fine.
well, let's see. Who would be the next House member up?
Delaney.
Congressman
Mr. Hanna.
Hanna. Yeah, Mr. Hanna.
Thank you, Chairman. Mr. Hoghaug, people would believe that the medical device tax, 2.3%, shouldn't be relevant. Doesn't sound like a big number to anybody. You listen to your statement, and incidentally, I agree with you, but I'd like you to do a little bit deeper dive and explain to this committee why it is that, and we know it's on your gross receipts, why it is that that percentage could have such a tremendously negative impact on, through Obamacare, on your bottom line and on your company.
Thank you for the question. First of all, it's an excise tax, which, even though theoretically people say will be passed on to the consumer, in reality, we cannot pass it on. Capitated pricing in hospitals, 70% decrease in actual pricing since 2008 has completely eliminated the ability to raise prices. Secondly, it comes out of our weekly or biweekly cash flow and is paid ahead of collections, profitability, irrespective of how a company is doing, including a startup, as one of my firms are. And then at the end, it's not tax deductible. There are a few opinions out there, but there are no IRS mandates that say where it can or cannot be deducted, perhaps at the state and local level, but certainly not on the federal. So if you were to take an $8 million company with a roughly $6 million profit of $480,000, it's about $248,000 in tax. If you're losing money, that $248,000 is still owed to the government, irrespective of when you collect it or how you collect it. And it just has stripped the day-to-day basic cash flow for reinvestment in the firm.
Thank you very much. Ms. Wade, you know, government sets all kinds of problems up for small business. It almost feels, and I'm from New York, one of the highest tax states, as if it's a war of attrition. That people think that businesses will stay in business. People and individuals don't get frustrated, don't quit, don't make enough money in their lives so that it just becomes marginally not worth it. I think you and I know that people do quit, people do give up, and the energy that it takes to create and grow and stick with a small business through your lifetime, regardless of awful things like inheritance taxes that may suck the lifeblood out of your business, just when the next generation needs it the most. The raw costs, the psychological costs, in addition to the just the specific costs. But you talked about the 179 deduction, and the fact that Congress, and Mr. Fledderman did also, it was so late. In a couple of minutes, can you explain to me, and I'm sure I already agree with you, but you notice there's nobody here in defense of this tax code today. The true meaning of not knowing the direction of your life, your business, the sustenance for your family, in the way Congress handled this last time, literally in the last moments, and how important and why the 179 deduction is important.
Sure. So small businesses, one of their major complaints is the uncertainty over government policies and frequent changes in the tax code, and 179 expensing covers both of those, unfortunately. So in our survey of Small Business Economic Trends monthly survey, we ask a few questions on capital expenditures. While capital expenditures are historically low since the recession, the December 2013, when the expensing limit was going to be lowered from $500,000 to $25,000, we saw a huge spike in the number of small business owners purchasing capital expenditures and planning that it would be lowered to 25 and not retroactive. So these fluctuations in tax policy certainly affect small business owners and how they conduct their business, and we think it should be better served that they conduct their business on what's best for their business and not driven by the tax
So you think
fluctuation.
all of this causes a misallocation of resources in many different ways for everyone?
Absolutely. Uncertainty is one of the huge problems that they face.
My time's expired. I yield back. Thank you, Chairman.
Well, thank you. Just for the explanation to both my colleagues and the witnesses and those watching here, we have somewhat of, as I said, a Byzantine system in place in terms of who goes when. The rule is that those that are here at the start of the committee are listed, and then they are ranked in terms of House, Senate, Republican, Democrat. We try to be fair to both chambers and to both parties. Then those who come and go fit in. We almost need to hire a staffer just to provide me a note, which gets revised about every 3 minutes. And then we have the question of votes over in the House. So we're trying to, if I overlook somebody or miss somebody or they're out of order, I apologize. We're trying to do the best that we can. I'm going to turn now to Senator. The way I have it on the list is Senator, of course, Senator Klobuchar has yielded her time. Not yielded, but deferred her time to the point where she looks over and tugs my shoulder at my sleeve and says, "I need it now." So you're welcome to do that. But first, in order, if we stay with our agreed on procedures, it'll be Congressman Paulson, followed by Senator Lee, followed by Congressman Delaney, and then we'll go from there, if that's all right with everybody. So, Congressman Paulson, you're on.
Well, first of all, thank you, Mr. Chairman, and the testimony was very good today. You know, we spent a lot of time in this committee gathering data over the last few years about how we're in a growth gap. The economy's underperforming. It's the slowest economic recovery ever, and wages are flat. Small businesses have really struggled. For the first time in 35 years, more businesses have failed than have started. And on top of that, we've got the medical device tax, some very powerful testimony we've heard today that is hurting one of our best American success stories. And, you know, I think one thing to just reflect on is that 80% of medical device companies are small businesses, 50 employees or less. And sadly, some of the stories that I've heard match the story, Mr. Hoghaug, that you mentioned of the impact on these device manufacturers. I talked to a company in Texas. They had never laid off an employee in 22 years, but they laid off 25 people, and then they deferred hiring another 15 people simply because of the device tax. And I hear other stories all the time in my home state of Minnesota, as Senator Klobuchar knows. And Mr. Hoghaug, you mentioned that in your written testimony, and you kind of got this a little bit with cash flow issues, in your written testimony, it mentions your effective tax rate as a company at Signus Medical is nearly 79%. You face one of the highest tax rates of any industry now in the world. I mean, it's surprising to me that you're still in business, and how can any of us sitting in front of you expect that you can continue running your business like that? Now, some claim that by the Congressional Research Service and others and supporters of the tax claim, there's no impact on jobs. It's not real. It's not really happening. As someone who's actually running a small business, Mr. Hoghaug, and understands what's happening on the ground, how do you respond to those critics?
Well, a great question. In theory, most of these studies that I've seen or read, it's all based on the fact that you can pass on this 2.3% to the actual end user. That is not my experience. We have not been able to. I haven't seen anything but a decrease in actual pricing since 2008. We're down about 70%, and thus profits are down. You tack on the 2.3% on top of that, and the cash has to come from somewhere. And as I mentioned in my testimony, one of the hardest things I ever had to do was walk up and lay off 2 people for the sole reason that I had to make my tax payment. Not because they were doing anything wrong, they were exemplary employees, but I had to lay them off, otherwise I'd be in default. And that's very real, and I haven't been able to hire them back because we're paying 50, 60 days in advance of collecting the actual money on a sale. So you're always playing catch up with the cash, but the bills always come in on time.
Now, you mentioned also that you've deferred or had to shelve some research and development products, and the surveys we've gotten back from the device industry says the exact same thing. And this is the lifeblood of the industry, right? I mean, it feeds into the supply chain of where we've seen all the success. Can you tell us a little bit about some of the patients that your devices have helped, and what's the impact of the device tax now on them?
Well, I have hundreds of stories of benefiting. One that actually has stuck with me for many years is a father bringing in a 16-month-old small child who was quadriplegic due to Down syndrome and a congenital defect at the base of the skull, and carrying his small daughter into the neurosurgeon I work with in Children's Minneapolis and saying, please, please bring my daughter back to me. And through the course of the surgery and implantation of our device, I was witness to the fact that she could move her fingers and her legs again, and while still has many, many challenges ahead, she was functional, and there wasn't a dry eye in the house. But those are the types of implants, and the next generation implant that could be out there to help more people, a greater number of patients. The research and development dollars just aren't there to take it to the next generation to supply it.
Well, I think that illustrates how this is really a tax on innovation, and as the chairman knows, coming from a state with a high propensity of medical device companies, and Senator Klobuchar knows, we need to keep this industry alive. And thankfully, this is one of those issues that has gathered bipartisan support for repeal, and I hope that we'll continue to be able to move this issue forward, and I would yield back.
Congressman, thank you. Senator Lee.
Thank you, Mr. Chairman, and thanks to all of you for your testimony that's been very informative today. Mr. Reardon, in your testimony, you mentioned that back in 2003, the full integration of the corporate taxation system came within just a few votes of becoming law, finally becoming reality, and you made a convincing argument that businesses should choose their form, their corporate form, based on the type of business they have, the type of business strategy they have, rather than having to game out the tax code. Can you discuss with us just a few potential ways in which full integration of business taxation might occur today, or ways in which the tax burden of C corporations and pass-through entities might be kept in balance so that the decision of how to organize a business is driven by business considerations rather than by the tax code?
Sure. Yeah, no, I'd be happy to. Thank you. I think the committee has discussed a little bit sort of this dilemma of that you have big S corps and you have similar sized C corps and they're taxed differently, and how do you reconcile that? And my argument is that the S corp is taxed correctly, so you should move the tax code towards that single layer of tax. And one of the ways to do that is to integrate the corporate code with the individual code, so that if you're paying tax at the corporate level, then there's no shareholder level tax, or vice versa. If you don't pay tax at the corporate level, then you have a shareholder level tax of an appropriate amount, and then that's the tax that the company pays. In 2000, and I guess one of the other sort of themes is that, well, we can't quite get there. There's no way to do that. Well, we came really close in 2003. The President's original proposal was full integration of the corporate code, where if a corporation paid a tax on the dollar that it made, then there would be no subsequent tax, either as a dividend or when the shareholder sold the stock as a capital gain. That plan passed the Senate. It came very close to passing the House, and that's the compromise was that we ended up with a 15% rate on cap gains and dividends, which got us pretty close to the idea of, you know, a single layer of tax, certainly much closer than we've been in since World War II. I think there's two ways to do it. My understanding with your plan is that you have, if the corporation pays a tax, there's no subsequent shareholder level tax. The challenge with that is the optics, that it looks like the shareholders aren't paying taxes when in fact they're carrying the burden of the tax paid by the business. And I think you guys get around that by having a notice sent out to the shareholder that this much tax was paid by the business on their behalf. The other way to do it would be to allow the corporation to have a dividends paid deduction, so that the corporation, when they kick out a dividend to the shareholders, they don't pay a tax at the corporate level, entity level, but that the shareholder pays that tax. I like that because it makes the tax explicit at the shareholder level. The challenge with that is that, you know, there's, I think, 40% of C Corp equity right now is paid by, or owned by tax-exempt taxpayers, IRAs, trust funds, college funds, et cetera. So how do you deal with those shareholders is difficult.
There's probably not an easy fix to that.
There's not an easy fix to that. So I think sort of your solution is probably the most elegant. But the bottom line is that, you know, if you want to make U.S. businesses more competitive, the double tax is the big challenge. Our competitors don't have double taxes on their tax. Most of our competitive, you know, countries that we compete with, they have integrated their corporate code with their individual codes. So we're an outlier there. We should fix that.
And once you have double taxation in place, that therefore makes it a lot more difficult to design a fair tax code, a fair business tax code.
Well, I think you have two challenges. One, it drives up the cost of capital because you've got the two layers of tax, and that means that you're driving investment out of the U.S. and into foreign markets. And two, you have a huge behavioral issue, which is, you know, one of our members testified before the House Small Business Committee earlier today, and in his testimony he talks about when they were a C Corp, they didn't want to pay dividends because they didn't want to face that second layer of tax. But if they have shareholders who rely on those dividends, then suddenly what's the point of being a shareholder of a company where you're not benefiting from the success of the company? That endangers the future of the company because the shareholders say, no, let's sell the business. Let's sell it to that big C Corp multinational down the street. And so the challenge is that, you know, if you're not going to, you know, I got kind of lost in my rhetoric there. If you're going to, you know, move the tax code in a correct way, you want to move away from the double tax. You want to make sure that business income is taxed a single layer, it's taxed at a reasonable rate, and then that's it. And you get away from both the cost of capital and the behavioral challenges.
Was this, by the way, the single biggest argument that sunk the 2003 plan that would have fixed it? Was it the argument that you're somehow helping?
I think there was opposition on some important people on the House side, but you'll have to talk to them about exactly why they didn't like the idea.
Okay.
Yeah.
Well said. I see my time's expired. Thank you very much. Thank you, Mr. Chairman.
Senator Lee, thank you. Senator Klobuchar.
Well, thank you very much. We're left to wonder who these important people are, but thank you very much.
It might have been the chairman of the Ways and Means.
Oh, okay. Well, I wanted to first acknowledge Mr. Hoghaug. Thank you so much for being here and the jobs you create in our state. And Senator Paulson has already, Representative Paulson has already mentioned how difficult this situation is with the medical device tax. He and I have both been working together to try to get this repealed along with Senator Hatch and others, and we're hopeful that this may be the year we can get this done just because of some changing politics and people understanding, and also a GAO report that came out showing how difficult it is to assess this tax. Just one other follow-up I had was just the R&D tax credit, if that's helpful. That's something else that kind of expires at the end of every year, and it's been a big frustration, and if you find that helpful, Mr. Hoghaug.
While on the surface it seems to be helpful, it hasn't, due to the length and kind of the uncertainty of the R&D projects with medical devices, not one outstanding being the FDA. as it changes every year, you can't get the entire project in under the deduction, and I don't know if it's going to be there next year. So we're planning as if it's not going to be there, and then we just have to look at cash flow and how much you can afford.
Exactly, and then it doesn't serve its purpose of creating incentive, which is one of the reasons we'd love to see longer-term comprehensive tax
Correct.
reform, as well as international tax reform. And I know I missed part of this, but we know a little bit about that from having Medtronic and all the trillions of dollars that are overseas. I was just talking to Senator Schumer about that. Even if we're not going to get comprehensive done this year, it would be nice to get that done. Other thing that I have found to be really helpful to our companies, manufacturing companies, is something you mentioned, is the Section 179, the depreciation tax credit, the expensing provision. And Mr. Fledderman, as part of the comprehensive tax reform, do you think we should be looking at the depreciation tables, or there some updates? It's the number one thing that's mentioned to me, and I think it was head of the Federal Reserve, Yellen, who also mentioned that it was a very helpful way if we could make that longer and clearer and make any improvements to it. It's one of our better tax incentives.
Yes, thanks for the question. It definitely would help tremendously, especially if we can count on it. You know, listen to all of this. One of the things that I think I'd like to say is we're talking about the tax incentives that there are, and it seems to me like we really don't have tax incentives. We have tax rewards for something you did, because we don't know that we're going to have it.
Especially when they're retroactive.
That's right. If you know at the beginning you're going to have it, then it really is an incentive to do something, versus you might get a reward for doing it. It's a whole different thought process when you're a business owner, when you have to make a decision on an investment or something like that. You know, I'm as patriotic as the next guy. But I've got to admit, you know, when we're getting ready to invest another $4, $5, $10 million in our business, I'm questioning, is this the best place to do it? Does it really make sense to put that kind of money here, and you don't really know what the return's going to be? And I don't like thinking like that, and I don't think that's the way we want business owners in this country thinking.
Agree. Thank you. Mr. Reardon, many small businesses in Minnesota actually are ESOPs, and I think you know they provide several tax benefits under the law. And can you talk about the benefits of ESOPs for small businesses? We have sometimes just tax changes we're very concerned could affect them, and there are some other issues. We got a ruling today out of the Department of Labor that we are concerned about on fiduciary duty, but ESOPs actually are exempt from it. Could you talk about the value of ESOPs?
Yeah, that was a real helpful ruling.
Yes.
You know, several of our board members are actually S-Corp ESOPs. And I think one of the primary value, aside from the fact that, you know, when you have an ESOP structure, it sort of changes the whole culture of the business, that people take a much higher level of ownership over both their jobs and sort of accomplishing the tasks that are within their responsibilities. But it also eases transition of businesses. And one of the biggest challenges for businesses like Mr. Fetterman's or Mr. McGregor's is, how do you transition from one generation to the next? Or if there is no other generation, what do you do with that business? Usually for closely held businesses, the people who have the best chance of succeeding with it, you know, after the first generation goes away, are the people who are working there. And so that's where an ESOP really comes in handy, because it eases that transition, it shifts the ownership to the people who are best able to keep that business successful, and then it creates a great retirement opportunity for them.
Okay, thank you very much.
Thank you. Let's see, my list has Congressman Delaney.
Thank you, Mr. Chairman. And I want to thank all of our witnesses for being here today. Prior to coming to Congress, I ran a commercial finance company that I started that across 11 years we financed 5,000 small to mid-sized businesses and made about $30 billion of loans. And I can say every single one of the businesses I ever financed always thought they were paying too much tax. And they're right about that to some extent, because let's face it, you know, earnings would be more productively invested in a business than they are paid to the government. But we do need tax revenues of the government to pay our obligations. And that's our principal responsibility as fiduciaries here. And so when we think about these changes, we have to be smart about them, and we have to do things that, you know, unlike the medical device tax, which I don't like because it's an excise tax. And the reason I think the witness had the problem with his business is because if it was an income tax, you would only pay it if you're actually making money, so you wouldn't have the cash flow problems. But I think there's two things. The first is I think we have to stop with the false choices between small and big businesses, because A, it's hard to find those lines. And Mr. Fledderman, it sounds like your business does a lot of work for the auto industry. Those are big companies. They're your clients. And so the fact we have a bad tax system for them affects you, too. And I think it's true for most small to mid-sized businesses in this country. A lot of their clients, at least of the 5,000 companies I financed, a lot of their clients were big businesses. So the fact that we keep their cash overseas because we have a bad international tax system hurts small businesses. The fact that they have all the same problems that you do hurts small businesses. So these false choices, because small businesses employ a lot of people, but there's a lot of data to suggest that it's actually fast-growing mid-sized businesses that create all the jobs. So I just think it's important for us not to have this false narrative. We have a bad tax code, and it's hurting all American businesses, full stop, and they're all interrelated. But my question is to you, Mr. Reardon. Let's assume for a second, because there is a fair amount of momentum, at least I feel, to do business-only tax reform. And I think the reason for that is that the ideological divide on individual tax reform is very wide at this point. So there's momentum to do business only. So let's assume we're doing that for a second. And let's assume we don't do what you'd like, which is to eliminate the double tax. And I understand all the reasons for it, but let's assume for a second we don't do that. How would you propose that we deal with all of the unincorporated businesses, of which probably 90% of businesses, I don't know what the stats are probably unincorporated? I mean, even one of our witnesses here, Mr. Hoghaug, you run a C Corp, it sounded like, and you run an LLC, right? So there's, these things are somewhat interchangeable. How do you think we can, if we were to eliminate deductions and lower the rates for C Corps, and we were not to do individual tax reform at the same time, how could we actually do something to address unincorporated businesses at the same time?
Well, for the record, we've always argued for comprehensive reform that addresses individual pass-through. And
my hypothetical assumes that doesn't happen.
Plan B is out there, which, I think it's sort of encompassed in what Senator Lee has in his plan. There's a Grant Thornton business equivalency plan out there, which would effectively cap the tax on pass-throughs at whatever the top C Corp rate is, so that you would divorce a little bit the individual rate from the pass-through rate, and basically treat it like capital gains. So when you have active pass-through income, it shows up on the shareholders level on their income taxes, and then it's treated to a different rate schedule than their other wage and salary income. I think that's probably the most fair way to treat the difference between C Corps and pass-throughs. Marty mentioned a number of other options out there. All of them would benefit certain pass-throughs, but the challenge is that none of them, unlike rates, none of them affect all pass-throughs the same way. And so if you do broader expensing, you're helping companies that have more capital expenditures, but there's lots of S-corps and pass-throughs out there that, retail and others that don't have a lot of capital expenditures, so they won't benefit at all. So they'll still be stuck with that higher rate. We've explored this, as I said, for 5 years, and we keep coming back to the rates. And, I would prefer to see...
What do you think the apples-to-apples differential is right now between a C Corp counting its double tax and a pass-through?
It depends
Who's paying more and by how much? I know it's hard, but generalizing.
Well, the effective rate study that we did,
yeah.
Looking at domestic only, because once you get into the international, it gets really complicated with all the credits and everything. S-corps were at 32%. C Corps were at 27%. That doesn't include, it does include dividends, it doesn't include the cap gains rate, so you should probably adjust the C Corp rate up a little bit. But I think, they're sort of in that range is right where they're at right now.
So if you did the proposal you're talking about, the spread would probably be similar, because if you lowered the rate, right?
Yeah, I think it would be fairly equitable, yeah.
Thank you, sir.
Congressman Beyer.
Thank you, Mr. Chairman, and thanks all of you for coming, and it's fascinating. I've been running a small business for 41 years, and very much identify with so much of what you say. The incredible difficulty of accumulating capital just because of the tax stuff. So Dr. Sullivan is a Harvard-trained economist. We heard early on, I think, Mr. Reardon's presentation about when you add up the medical device tax, or rather the Affordable Care Act tax, and you get to 44%, 43.4%. When you add Virginia's 5.75% personal or state tax, you're over 50. And then if you look at the part that we take out for ourselves for Social Security, that's another 15.4%. So it's 65% or something on the first $107,000, then drops down. Is there any theoretical economic research that shows where that ideal theoretical tax rate should be, where you start to get the disincentive not to work, where it just doesn't make any sense to try as hard as it does when you're a small business? Yeah, at what point do we say, 50% is perfect, or 40%, or 60%, or 29%?
Well, I think there's no magic number out there. It's certainly subject to a lot of controversy, but we want to keep the rates certainly as low as possible. I think the question when we're talking about small business is there are a lot of individuals who are not involved with small businesses who are subject to these high tax rates. And so it's not, when we talk about lowering the rates, it's not just affecting small business. So that if we want to help small business, it doesn't make a lot of sense just to focus on the rates, because then you're helping all individuals who have very high incomes. So if we want to promote job creation, we should give tax breaks to the individuals who are actually creating jobs. And so I wouldn't focus so much on the rates as to focus on the job creation part of the equation.
So I was impressed with options 4 and 5, option 4 being the upfront tax benefits like the costing, expensing, and option 5 being tax simplification, the huge tax burden. So years ago, when Bill Clinton was first elected president, I talked to one of his chief economists about one of my great frustrations, which is I don't mind paying 39.6% tax on the income I take out of the business, to buy my big house or to pay the country club bills. It drives me crazy to pay it on the money I want to leave in the business to grow more jobs, to expand it. Is there not an option 7 here or an option 6 that says you could do those same tax rates on the money that's taken out, but a much, much lower rate on the money that's left to grow the business and to grow jobs?
Well, I was just at Harvard last week talking to the law school professors there, and they were, Professor Halpern was suggesting that there should be tax relief for money that is kept inside the corporation. And so I think there are options like that that people are interested in, for sure.
I think maybe going to ask our chair and ranking member if we can pursue that together, which would be excellent. Thank you, Mr. And I'm hoping Mr. Reardon could help us think about that also. Mr. Hoghaug, one of the arguments made about the medical device tax was that you were going to sell so many more artificial hips and pacemakers and like that it would offset it. Do you see any uptick in demand from ACA?
No, great question. No, we've seen zero uptick. Most of the devices, spine in particular, but I also involve shoulder and other joints, are diseases of the aging and elderly. Those people either have insurance or are covered by Medicare. So we've seen no appreciable rise at all. A trauma patient that goes in with a broken neck is going to get treated whether or not they had insurance. So those numbers really haven't changed at all.
Would deductibility and alignment of the cash flow make a meaningful difference for you in the medical device tax?
I just think it's an entirely bad idea to be taxing in any way the innovation. I'm not sure how one could reconcile that. I mean, it seems that the majority of the House and Senate are in favor of repealing this tax as it really is a tax on innovation. And, by not being able to reinvest within the company and on the next new generation product, the patients are suffering.
Thank you, Mr. Chair.
Yeah, terrific questions. I mean, you got our attention on those couple of items there. Yeah, thank you. Congressman Schweigert.
Thank you, Mr. Chairman. Though, is it Congressman Bayer? If you're paying your country club fees, you belong on this side, right? So if I turn to this august panel and said, all right, optimal tax system, and from a personal, and we'll get down to the doctor in a moment, philosophical vision, a tax code that maximizes economic growth, economic stability, but minimizes decision-making directed from the tax code itself. Because I believe as regulatory policy, when it's outside certain realms, but also tax policy, we distort price effects. We distort allocations. Starting with Mr. Reardon, just then describe to me, what is the optimal tax code?
If I were writing the tax code in this current environment, I would shoot for a rate that's sort of sustainable in 28–30% range, and then I would tax all income at that rate. And as I said, we would incorporate or integrate the corporate code. So you'd have a 30% rate on C corps, 30% rate on pass-throughs, and a 30% rate.
And you'd create an equalization or deal with the differential on the C corp and its dividends.
And on the individual rates as well. You know, I disagree sort of a little bit with what Marty's saying about, you know, sort of, you know, what rates you can apply to wage and salary income, simply because, you know, capital has to come from somewhere. And the only way that you're going to get capital for people to borrow or to invest is for people to be able to earn money and then save it and then turn it invested in those enterprises.
Mr. Fieldman, does that accomplish what you need?
Absolutely, I agree 100%. I think that a simplification of the tax code helps both the businesses because we can plan, and I think it helps the federal government because they can plan. Right now, the government doesn't know what kind of credits I'm going to submit for at the end of the year, so I really don't know what kind of returns are going to be necessary. It'd be a lot easier for us to calculate what our tax burden is going to be, and for the government to calculate what the tax take is going to be. I'm all for paying my fair share of taxes.
Well,
and a flat tax would, you know, simplified would make it the same for everybody.
Ms. Wade, what would be the optimal tax code?
For NFIB members, they've told us time and again that lowering the rates, and that's for all demographics of small businesses, regardless of industry or their growth potential, lowering the tax rate, but then also making permanency the state tax repeal and 179 expensing, so that the frequent changes in the tax code isn't driving their business decisions.
What if you lowered rates to the point, but you removed things like 179?
We've surveyed our members, and there is a little bit of negotiation, but it all comes down to what they're paying bottom line on tax costs.
That's what it's always about, right?
Yes.
It's always about trade-offs. I mean, you know, NFIB members want lower rates and they want expensing, but you're asking the question, when we only have so much, we have to raise a certain amount of revenue, what's the best way to do it? And
well,
I think
in the most, remember, my preposition is based on the concept, what maximizes economic growth and minimizes economic distortion by tax policy.
And the answer is tax reform in the classic sense. We want a single layer of tax on all businesses, and we want rates as low as possible. And there's going to be some very painful loophole closing that's going to have to take place for that to happen. When I was on staff, I was always lobbied. I'm sure you're lobbied, and you're told that if you take away this tax break, it's going to hurt jobs. But ultimately, all of those tax breaks are really hurting jobs. Okay. And you need to lower the rates and sort of ignore that patter about, oh, you're going to kill jobs by taking away my tax break.
Okay. In a world like you have, where you're putting money into R&D for medical devices, what's optimal for you?
Well, twofold. Once, I agree. I'm not an economist, but I would agree that a lower, flatter tax, corporate tax, would certainly induce reinvestment within the company and in R&D. The elimination of the medical device tax, which is punitive on my startup company, has yet to turn a profit but still pays taxes. So I'm actually borrowing money and financing to pay tax.
Okay.
And but I would agree that, you know, just some extension of the R&D tax credit or something, just something that we could plan for the future.
All right, and thank you, Mr. Chairman, for your, there was one comment I wanted to make. We need to be a little careful. Earlier, we threw out things of, what if you were an investment company or a hedge fund or this and that, and the title or the structure, we should probably be concerned about what's the profitability, what's the actual income from it. Because there was a time I ran a fairly large investment fund and made no money from it. But I had a really big title. So we got to be very careful with the stereotyping because it sort of distorts, when we get down to this sort of what's the actual best for the economy, best for the country. With that, I yield back, Mr. Chairman.
Well, thank you, Congressman. The Senate has called a vote, and I'm going to have to leave shortly. I would be happy to turn this over to our ranking member, Congresswoman Maloney, if you want to continue with some additional questions, or if you have additional questions. It seems to me, and I am not trying to categorize everything into a conclusion here, but what I've heard today is that tax reform is a necessity if we're going to promote economic growth for the future. Comprehensive tax reform seems to be the best way to go. The piecemeal continues the complexity and some unfairness. Making it fair and simplifying our tax code, lowering rates to the extent that we can, particularly dealing with the question of relative to business income. Where is that sweet spot where you can lower the rate and eliminate the exemptions or the trade-offs? Because if you want to achieve fairness, you want to achieve simplicity, it seems to me that, and get that fairness, you have to give that consideration. Is there a level at which you could say, give me that level, that provides the certainty that I need, that I know exactly what I'm going to have to pay on the income that I earn and the profits that we achieve, and I don't have to hire attorneys and CPAs to figure out how do I qualify for a certain exemption, a certain deduction. I think that's a challenge for those of us that are going to have, all of us here in Congress are going to have to address the need through comprehensive tax reform, that very question. We've talked about a level as you've gone through this. I don't think we need to report that. And then locking in certainty seems to be a key component of getting a pro-growth, dynamic economic tax code. We talked about what I would think are two confiscatory, egregious taxes, and then one is the medical device tax, which I think our witness here from Minnesota, and I've experienced the same thing in Indiana. We are a medical device state also. I have seen and heard from those who own the companies who have not yet, who are at potentially innovative breakthroughs that can substantially improve health and save lives, but simply aren't not going to be able to get there or pursue their technology or their innovation because they're forced to pay tax on their sales as an excise tax and not on their profits. They're not making a profit. They have to borrow money to pay the tax. They have to lay off people. We have had companies that have planned expansion, planned new hiring, and canceled as a result of this tax. It's egregious to take this, particularly this type of innovative industry that has so much promise for future health benefits, to just slap a excise tax. And it was all based on the fact that you would have a surge of business from the Affordable Care Act, which you've indicated has not been the case, and that's true with many of our smaller companies in particular. And then the estate tax. I know the House will be voting on this. I'm not sure if the Senate has the votes to address this, but in many instances, not in every, because there's some inherited money passed down clearly that, but this is money that has been earned money that has been taxed, and then you get to do it all over again, almost half of everything that you saved, and give it back to the government the second time. I think this has been a very constructive hearing. I thank our witnesses for being here with some terrific questions that have been asked, some very good answers that have been given. I think this will play an important role in terms of how we determine how we go forward with achieving the goal I think we all want to have, and that is taking a very complex, out-of-whack, desperately needed tax code reform piece and make a sensible accomplishment here relative to what is necessary to get our economy not hindered by the complexity and the unfairness of this particular code. So thanks to all our witnesses, thanks to my colleagues here. With that, this meeting is adjourned.